7 visuals every trader should know. These are going to be an expansion upon 7 visuals I shared on my Twitter, and really every single trader should know these as they really explore some key concepts in trading that when visualized can really help you understand them and actually see how important they are to your trading. So let's get straight into it. The first one is probability of X consecutive losses based on the win rate. So if you had a 50% win rate and you were looking, what is the chance I have 3 losses in a row? We can see that's 100%. So at some point in your trading, over 100 trades, there's a 100% chance you will have 3 losses consecutively with a 50% win rate. Now we could go down and see how this kind of affects it. So on a 20%, how likely is it really to have, let's say, 10 losses in a row? It is 100% likely. And this is really important for every trader to know because it really helps you visualize and understand your risk and how likely you are to have consecutive losses and for it to be normal. So if I'm trading a strategy that has, let's say a 30% win rate, I can visually understand now and be like, okay, I totally accept and understand the fact that just mathematically, there's going to be a time where I have 8 losses in a row. And I know during that time, that is gonna, that's gonna be a tough time. Having 8 losses in a row can really test you mentally, but at least seeing the numbers clearly to you can help you better understand and kind of prepare for it. Whereas if you just went straight in, didn't know about this visual, and you just went and traded a 30% win rate system, having 8 losses in a row, you would probably think is broken. I would think most traders would think that, and I think it'd be very rare to get a case where someone wouldn't be, thinking along those lines that they should be changing the parameters, or they should just, scrap that system because it's just completely useless and it doesn't win over time. And we've had 8 losses in a row. That's just ridiculous. And that kind of lets you illustrate the idea of why this is really important. The next one is relationship between risk, reward, and win rate. So what we can see here is a curve between the required win rate and the risk to reward ratio for you to break even, which is the line. And then on the other side is profitable, and this side is all unprofitable. So we could see here, if you had a 30% win rate, you would need about 2.5 risk to reward ratio to be a break even trader. And you need probably more than it to be profitable. So this allows you to, just kind of like with a similar one as where you can visualize how win rate affects it, you can also see how risk to reward really affects your system. And this also is kind of going into 2 key parts of why I only really trade high win rate strategies. The first main reason is just mentally and based on my psychology. If I was to have 8 consecutive losses in a row, even if I knew the maths behind it, I think most of the time, and proven with my kind of like first 2 years of trading or first year and a half, I wouldn't be able to withstand it. I'd probably mess up. I'd probably change the system. I'd get emotional. I'd oversize, thinking, the 9th trade is got to be a winner, 100%. But there's still a percentage that there could be a consecutive 9th loser. And my brain would forget about that. I would just oversize and get straight into it. And if you can relate to those kind of struggles, then I would definitely say, aim for a higher win rate kind of strategy. Don't go, you're not going to find a 99% win rate strategy. But there are definitely edges out there that have 60, 70, and 80% win rates. Now, there's either going to be a couple caveats with that. So a higher win rate system normally has a lower risk to reward. This is also, you can see by this graph that's good because you can still be profitable even with a lower risk to reward. But that is normally just how edges tend to be. I personally never have found a high win rate and high risk to reward strategy. If you do, I'd say that's probably the golden kind of like trio. You could make insane profits if you had all of those. But realistically, my kind of strategy, I'm looking for a 70% win rate, and normally I'm getting 1.2R to, on a really good outlier day, like 2.5, maybe 3R max. And that, keeps me profitable. And the main important thing there is it aligns with my personality. And I can keep on trading that system because I know realistically, I'm not going to have more than like 3 losses in a row. It would be quite rare to have 4 or 5. And within that kind of range, I can withstand that. I can keep sticking to rules. Personally, I don't find that as mentally troubling as like 8 losses. Next is gains required to make up for percentage losses. This is really important to know just for, I think this graph is normally used for longer term investors just to understand that, if your portfolio is down 50%, how much do you need to make it back? But it's also really good for traders because once we're having these kind of drawdowns, it's really important to start cutting size or making sure you're not digging yourself into an even deeper hole because it can become very difficult to get out of. So we can see, around the beginning, if you lose 10%, you only really need 11% to make it back. If you lose 20, you need 25%. So it's still quite manageable, at least in my opinion. If you lose 30, then you got to win back 43%. If you lose 40%, then you got to do 67%. 50%, you have to have 100%. And you can see there there, it starts to compound very hard, where obviously if you're in that kind of blow up stage and you've lost 90% of your capital, you have to make 900% returns to recover that just 90% you've lost. So a lot of those times, and when I've personally blown up a decent amount of an account, I've just gone, got a part-time job, or I had a job for a while and recouped those savings, because realistically, the gains you will make by working a job and recouping that capital is going to be way faster and a lot more consistent than trying to aim for a 900% winner. And some people can get lost in that kind of rabbit hole, especially in crypto and places where you can get those really huge moves. During a hot cycle, yeah, they may come off more often than, nowadays, but still, that's something I wouldn't be casually betting on, because to try to find even a 400% winner or a 900% winner is incredibly rare. It's in the zeros of kind of percentages. Next is the time value and the power of compounding. So this is kind of similar to the last one, but on the opposite end of things. So most people, I think when you first start getting into trading, you look for huge winners. You look for making those 100% returns on one single trade. And this allows you to see that small winners can really add up in a percentage way. So if you had two 40% returns, you would actually get a 96% return on your original capital. If you had four 20% returns, you'd get 107% on your original capital. So you're basically doubling it, just a bit more. Now, if you had 12 10% returns, you are doing 214% return on your original capital. Now, if someone was to say, I think, before reading this or getting into trading, if someone was to say, hey, do you want two 40% returns or do you want 12 10% returns? You would think, well, hey, I'd probably go for the 40%, or maybe you'd go for the 20%. I think it'd be a very rare circumstance someone would go for the 12 10% returns. But that is the power of compounding with, compounding kind of growth of adding more size based on a percentage way and kind of calculating it that way. So hopefully this kind of like shows you that idea that you don't need to aim for those huge home runs, and you still can make very good returns with a smaller return per kind of trade. The formula to the expected value. So this is a really good one, because this allows you to see what is your expected value on your average trade. Now, there's quite a lot of ways to interpret this and use it, but the most fundamental way is if you have this for each one of your strategies, you can understand that this is actually providing you an average return, and it is positive and it's actually making money. Whereas if you work this out and find out a strategy is actually losing you money, and especially if you have a portfolio, this can be really useful to just kind of quickly identify those ones that are actually bleeding capital instead of making a return. And you can work this out using the formula shown on here. Next is the learning curve. So the learning curve, I think, is a fundamental one that can be applied to all areas of life, because it is just learning, and a lot of life is just learning new skills and learning new things. So what this really takes you through is, you can see at the beginning, we all have this ignorance and we all start to find it fun. Most of the time, if you find an activity that you want to start learning, you'll find it fun in the beginning. You'll make a lot of quick wins, and that makes it really enjoyable because you're learning new things, and it's just kind of fun overall in the beginning. Maybe you even have a bit of beginner's good luck. And then you have a dip and you're thinking, oh, this is kind of hard, maybe you get over that. And then you have your second level of confidence. You think you now, because you've overcome those challenges, you really know what you're doing. You then think you're the ultimate king, you know absolutely everything. And then this is normally where, once people start feeling like that, especially in trading, and I talk from experience just on how I felt, that is when you start to bleed and bleed very hard. And you'll probably go through a big learning curve there of understanding that this is, there is so much more that you need to understand. And this is where you'll probably, some people will go to different approaches. Some will quit trading completely. Some will maybe double down and keep on learning what they're currently trying to do, which is personally what I would recommend most of the time. Depends obviously on individual circumstances. And then once you've kind of got through, then you're really starting to click and kind of get exponential growth from there. And then what I personally believe, at least in trading, is you go through a cycle every single stage. So you'll have a stage of where you feel like everything has clicked and you'll get to that new level. So maybe you're risking 1,000 per trade now. And then after that, once you try and get to 2,000 per trade or 3,000 per trade, there's a new level that you have to overcome. And I, at least from talking to, traders ahead of me and behind me, this is kind of a classic cycle for everyone to go through, that it's kind of peaks and troughs, and you'll level out and then you'll have a new level that you'll have to try and conquer. But this is really just interesting. I think a really good perspective to have this laid out, because if you have this on your wall or on your computer and you can understand this kind of concept, when you're going through the process, you can identify where you are and you can start to get ready and kind of have that preparedness that there's going to be a new level of challenges that you're going to have to overcome. And if I had seen this at the beginning of my trading kind of career, this would have been just amazing, to be honest. Because I went through this whole cycle. I could probably name you the times in the year where I was feeling like this. And I think if I'd seen it, I probably just would have had a bit more perspective. And I think perspective is the biggest thing in life, where if you have that perspective, you can overcome a lot of things because it doesn't seem as challenging as it does when you're kind of, going blind. The last one, and this is personally a favorite one of mine, is the law of large numbers. The law of large numbers is the principle that the average of the large numbers of random events will be close to the expected value of those events. So in trading, this means if you're taking more trades, and as you take to more trades, if your expected value, or just basically the mean of your trades, is actually not profitable, the more you take, the more it will come to that kind of center focus where those trades aren't actually profitable. I think a better way to explore this is basically saying, if you bought one lottery ticket, you would actually have a higher chance of winning big. But if you bought, let's say 100,000 lottery tickets, the average lottery ticket is actually negative. It is losing you money. And that would result to the mean where if you've bought those 100,000 lottery tickets, you'd probably be at the mean value compared to if you just had that one lottery ticket where potentially there's a bigger chance of winning big, if that makes sense. And I think the core thing of this to demonstrate to traders is you need a strategy that is profitable, and you need a strategy that is actually having a positive EV on average. If you don't, then realistically, the more you trade it, the more unprofitable you're going to be, and there isn't going to be a way to get out of that if you don't have an edge. And that's why I'm so big on backtesting. That's why I did the backtesting bootcamp, and that's why mainly I talk about data and statistics on my Twitter, because I think fundamentally, if you don't know that and you're just trading blind, it can be a cruel process to go through, because the more you trade, realistically, even if you're getting better, you're not going to be more profitable if you don't have an edge. And that's kind of the core idea of this. And this also applies to other things in trading, just in statistics wise as well. But that's the main message I was trying to convey with this. Thank you for watching, and if you enjoyed, please like and share it with anyone else who might be interested. And I hope you guys are enjoying this webcam kind of style of things. But thank you very much, and I'll see you guys on Twitter.